Welcome to Chapter 14. In this chapter, we will be discussing long-term financial liabilities. There are 5 learning objectives in this chapter, and the most important learning objective is number 2, where we learn how to account for long-term debt. So we'll spend quite a bit of time on learning objective 2. The tutorial videos that correspond to each of the 2 parts of this lecture are important, and I recommend that you view them and spend time going through questions. Let's get started with the lecture component. Our first learning objective is to understand the nature of long-term debt financing arrangements. So what is long-term debt? Long-term debt consists of obligations that are not payable within a year or the operating cycle of the business, whichever is longer. They'll probably require future outflows of economic benefits, and they're reported as part of long-term liabilities on our statement of financial position. So common long-term liabilities include bonds payable, long-term notes payable, mortgages payable, pension liabilities, and lease liabilities. In this chapter, we'll be focusing on the first 2, bonds payable and long-term notes payable. Financing arrangements are generally documented in a legal contract. This contract determines the rights and obligations of the lenders and borrowers. It will state the terms of the arrangement, things like the interest rate, the due date or dates, call provisions, any property that's been pledged as security, and any other type of requirements. These agreements often include terms and conditions that are meant to limit the activities of the borrower. For instance, it may restrict their ability to distribute dividends. It may require them to maintain certain capital ratio calculations, and it may create a limitation on additional debt, as the primary lender wants to ensure that there are not second and third mortgages being taken out. Bonds are a very common type of long-term debt. Their main purpose is borrowing for a long term when the capital required is too large for one lender. So it's too large for one chartered bank. You may go to the bond market. Bonds can be issued in a variety of denominations. They're created by a bond indenture, which is a bond contract, and they represent a promise to pay the face value of the bond back at the maturity date, as well as interest specific to what's stated on the bond itself. Bonds can be sold in different ways. They can be sold through an investment banker. They can be sold where the investment banker underwrites it and guarantees the proceeds to the company. They can be sold on a best effort or commission basis. And they can also be sold through a private placement, which is where the company organizes to sell directly to a financial institution or a large institution without the aid of an underwriter. So long-term notes are very similar to bonds. Technically, the legal nature of them is different, but in essence and from an accounting perspective, long-term notes are accounted for the same as long-term bonds payable. Types of long-term debt, basically bonds and the different characteristics of the bonds are going to change the risk profile of the company and therefore the pricing of the instrument. Just to put it out there, there's a whole bunch of different types of bonds. This isn't important from an accounting perspective necessarily, but you've got bearer bonds, which are not recorded in the owner's name. You've got secured debt, which is secured by some sort of collateral. You've got unsecured debt where it's not secured by collateral. You've got term bonds or notes, which mature on a single date. You've got serial bonds or notes, which mature in installments. Perpetual bonds, which may go on for over 100 years. Income bonds, which don't pay any interest unless the company is profitable, and revenue bonds, which is where interest is paid from a specific revenue source. Bonds can be sold at a deep discount where they pay little or no interest, but they sell way below their face value. They can be backed by commodities. They can be callable or convertible. Credit ratings are important for bonds. Most corporate bond issues do come with a credit rating. And this is an assessment of a company's ability to pay the amounts owing when they're due. So this gives the person, the person that's purchasing the bonds comfort that the issuer is going to pay back the face value and be making those interest payments. So this credit quality is constantly monitored and usually reassessed annually. And the best credit rating is AAA, which means that the security would have the lowest rate of default. And below BBB is below investment grade. So those securities usually have to come with a premium to make them attractive because they may have a higher default rate. Defeasance is where a company may wish to pay off its debt prior to the maturity date. And this isn't as easy as it sounds. Even if you have the cash, there may be a whole bunch of different bondholders. So you're not able to pay them back before it's contractually due. And there could be early payment penalties as well. So defeasance is where a company can set aside the money in trust and have the trust repay the debt when it becomes due. And depending on if the creditor agrees to this or not and how many bondholders there are, the creditor may or may not give up its claim to the company and just change the claim to the trust, or it may just be a grossed up transaction where you have cash on your balance sheet and then you have the bond payable. And you're just waiting for those two things to be settled. Companies need debt financing for a variety of reasons: to invest in capital projects, expansions, and companies can raise cash through three sources. They can borrow, they can issue equity, or they can use internally generated funds. Leverage is where a company is using other people's money to maximize returns. So for instance, issuing bonds. And capital intensive industries usually have more borrowing power because they have more assets that they can use as collateral. Great, so let's move on to the next learning objective. So learning objective 1 was really just giving you a flavor of what notes payable are and just giving you an introduction into what bonds are, and some common terminology and some different types of bonds. Objective number 2, you can see I put a star beside it. This is our most important learning objective in chapter 14. And this is where we learn how to account for long-term debt. So let's start with bonds and notes issued at par. So when issued, bonds and notes are valued at the present value of their principal and interest cash flow. So whatever cash changes hands is usually generally fair value, and we add any directly attributable issue costs, assuming that the bonds are going to be measured at amortized cost, which is the most common measurement for bonds. So let's look at an example right off the bat here. So what does it mean that it's issued at par? Well, a company issues 10-year bonds with a par value of $800,000 on January 1st, 2020. Interest is at 10%, payable semi-annually on January 1st and July 1st. The bonds are issued at par. So what does that mean? What that means is that the face value of these bonds is $800,000. It means that the company actually received $800,000 for the bonds. So they're issued at par. So the face value on the bond, the actual certificate of the bond, whatever that face value says, is exactly what the fair market value was for those bonds. So they're completely equal. That means it's being issued at par. This is the easiest scenario. It means we don't have to worry about amortizing any premiums or discounts, which we'll talk about in a little while. And so par is really that perfect scenario where everything's just aligning and there's no difference between the market interest rate and the bond interest rate. It also is conveniently the same between IFRS and ASPE. So there's no difference in accounting here. So bonds issued at par are really quite a good, easy question. Good, easy scenario from an accounting perspective. So let's take a look at what the journal entry would look like for that scenario that we just talked about. So if a bond is issued at par, the cash received is equal to the face value of the bond. So like we just said, we're right in this perfect equilibrium. So the bond face value was $800,000. The bond's issued at par. That means we're actually going to get cash of $800,000. Normally, the cash that we would receive would be the present value of the bond. But in this scenario, because the present value is the same as the face value, we're getting exactly that $800,000 of cash. The first interest payment is just going to be our $800,000 times the interest rate that it gave us of 10%. And it's important to note when you're working through these questions, how often the interest is paid, because we're always dealing with annual interest rates. But in this scenario, the interest is paid twice a year, paid semi-annually. So then we're multiplying it by 6 over 12, or you could also multiply it by 1 over 2, half. 6 over 12 is 6 months out of 12 months, same thing. So that gives us $40,000 that we are going to pay out in interest expense every 6 months. So you can see the journal entry there on July 1st is debit interest expense for $40,000, credit cash for $40,000. And then at year end, we need to accrue the interest payment. The interest payment actually isn't due until January 1st. So we're accruing it 1 day early. So therefore, we're going to record the credit in this entry to an interest payable account as opposed to cash. The cash will go out on January 1st. And the debit to interest expense is that $40,000 again. So our interest that we pay out on the bonds is the same each period because it's dictated by what the actual rate is on the bond itself. Another thing that's important to note, just before we move past this example, is it's important to remember which position you're being put in the question. So are you the company issuing the note, or are you the person that bought the note? So in this scenario, if we look back at the question, it says a company issues. So in this question, we're actually in the position of the company. So you can see where the first entry is debit cash. So the company gets the cash, and then we have a liability to pay back the bondholders. And then you can see it's our interest expense, and then we have to give out the cash. Very often in these questions, we are put in the position of the company, but it's always important to remember if you're in the opposite position, then whether you are getting the liability, so you're the one that's owed, or you're the one that owes, you're the company that owes it. So notes issued at par. So the accounting for notes issued at par is the same as bonds, so no difference. So whether the question says that it's a note payable or a bond payable, it's exactly the same. And you can see that the stated rate and the effective rate will both be the same. So here's another example. It says a company issues a 3-year note for $10,000. The stated rate and effective rate are both 10%. So because the stated rate and the effective rate are the same in this question, that means that the bond will be issued at par. It's only when we have a difference between the stated rate or the actual rate on the bond certificate itself and whatever's going on in the market that we're going to have an issue. So because those things are the same, we know that we're back in this scenario where everything is at par, and we know the notes for $10,000. So we are going to have, we're going to get in $10,000. When the stated rate and the effective rate are the same, the present value of the note is the same as the face value of the note. It's interesting here because there is actually an error on the side. This should be, let's just fix that. So this should be, let's actually just change this to 100,000 just to keep it the same. So it's a $100,000 note, and you can see we're getting $100,000 in there. So don't let that confuse you. Basically, whatever the face is here, oops, then the journal entry is going to be exactly the same. So no difference. Okay. Discounts and premiums. So we are covered par. I think we have a good basis in that. We'll look at some other tutorial questions later during the first segment of tutorials for part 1, chapter 14. But let's move on here and talk about discounts and premiums. So some things we need to understand is what's a stated rate, a coupon rate, or a nominal rate. It means whatever is on that bond certificate. So the bond certificate says this bond is worth $100,000 and it will pay out interest at 8%. That's the stated rate on the bond itself. The face value is the principal amount or the maturity value. So in that example that I just said, if it said the bond is worth, I think I said $1 million, if the bond is worth $1 million, then that's what it would say right on the bond certificate. Discount is when a bond sells for less than its face value. So the bond itself says $1 million, but that doesn't mean we're actually going to get $1 million for it. So if we're going to get less than $1 million for it in cash, that means we're selling it at a discount. And same thing, if it's at $1 million and we're going to get more than $1 million for it, then we're going to sell it at a premium. An effective yield or a market interest rate is the rate in the market that's going to dictate what investors expect to receive. There is an inverse relationship between the market interest rate and the bond price. What does that mean? Well, if the market rate is higher than the stated bond rate, investors will pay less for the bond because they need a higher effective yield. Okay, so that's a lot of words. What does it mean? So you've got a bond here. The bond says it's worth $1 million and it's going to pay out interest at 8%. If the market rate is 10%, is that a very good deal for an investor? Why would an investor buy a bond that only pays out 8% if they can buy another investment and get 10%? It doesn't make sense. So the reason that they're going to pay us less than the $1 million is because they need to make a higher return. They need to make a return on that investment that's going to be equivalent to 10%. That's going to be equivalent to whatever they can get for their opportunity cost. So they're going to pay us less, and that would mean it's sold at a discount. So in this paragraph here, it says the market rate is higher than the stated bond rate. So in that scenario, the market rate was 10%, but our bond rate was 8%. Therefore, they were going to pay less because they need to make 10% on this bond. That means we're going to get less than $1 million, so we're going to sell it at a discount. Now, alternatively, same scenario, we've got this bond certificate. It says $1 million, it's going to pay out interest at 8%. If the market rate is 6%, then wouldn't every investor want to buy this bond because it's a really good deal? They can make an extra 2%. Well, no, the amount that we'll actually receive for the bond will adjust for the market rate. So we would expect to receive more for this bond because it will pay out 8%. The market rate's only 6%. So the investor should only get an effective yield of 6%, which is the market rate, which means that this bond is worth more. They should pay us more than $1 million. That means it's going to be sold for a premium. Okay, let's look at an example here. Let's look at an example of a bond issued at a discount. Company A raises $100,000 in bonds repayable in 5 years with an interest rate, a stated interest rate, so on the bond of 9%. Interest is paid at the year end. The market rate is 11% at the date of issuance. So without thinking about the journal entries or the calculations, first of all, do you think that an investor will give us $100,000 for this bond? Will they give us more or will they give us less? Well, let's think about that. So this bond is going to pay out 9%, but the market rate is 11%. So this investor is going to need to make an effective yield of 11% on our bond that only pays out 9%. That means they're going to pay us less than the $100,000. So we know we're going to be issuing this bond at a discount. It's really helpful in these questions as we get into different calculations and as we're looking at journal entries to think about it logically and make sure that your question is going in the right direction. Next, we've been asked to record the journal entry for the issuance of the bond. Okay, so the first thing we need to do is figure out what is the present value of the bond. So how this works is, so back to our example where we had a par, the market rate and the bond rate were the same. So it was exactly, we were getting the same cash as the face value of the bond. Now, when you have a market rate, in this scenario, we've got a market rate of 11%. We've got a bond rate of 9%. So we've got a gap here. So we are not going to get $100,000 for this bond. We're going to get a different amount. We know we're going to get a lower amount, but we don't know what that amount is. And that amount is going to dictate how much cash we get from this issuance. So we need to calculate the present value of the bond in order to figure out how much cash we're actually going to get in. We know we're selling at a discount, but we don't know for how much. So let's get out our financial calculators. I personally find financial calculators easiest because we use them quite a bit in Financial Accounting 1. You can also use Excel to calculate the present value if you prefer, but I'm going to walk us through it on our financial calculator. So looking at our financial calculator here, I'm not sure why that's not showing up, it's red. Okay, financial calculator. Okay, so let's see. So this is what we know. So we know that the bond has a value of $100,000. So we're going to have to repay the face value of the bond has to be repaid at maturity, the full amount. So that's our future value. Then we've got it's 5 years, which is our N periods, number of periods. We've got 11% here. So this is really important. I made a note here. So when you put in your interest rate, it's always the market interest rate, not the bond interest rate. The bond interest rate is going to calculate our payments in the next line here. This will give us our payments, but it will not give us the interest rate, the market rate of interest. And our payment is going to be $100,000 times 9% is going to be $9,000. And then go compute present value. Okay. Our present value is $92,608, which makes perfect sense because we know that this bond is going to be issued at a discount. So that's lower than the $100,000, which jives with what we were expecting. So we're getting $92,608. So our journal entry to record the bond. So we're going to get in cash, debit cash of $92,608. And we're going to go credit bond payable. We're putting a long-term liability on our statement of financial position for the same amount, $92,608. And that's at issuance. The present value determines the selling price of the bond. So the reason in that question that the investors are paying less than the $100,000 face value of the bond is because the bond has a coupon rate of 9%, which is lower than the market rate of 11%, meaning the bond is worth less than the face value. So just driving that point home, making sure that you understand why we're not getting in 100,000 of cash, we're only getting in 92,608 of cash. The price at which bonds sell is typically stated as a percentage of their par value. So these bonds sold at 92.6. So 92.6, so 100,000 is the face value times 92.6 would get you 92,608 or 92,600, very close. Typically in accounting, bonds are subsequently measured at amortized cost, both for ASPE and for IFRS. Interest is adjusted for any premium or discount to bring the rate to the effective interest rate. And ASPE allows the straight line method to be used for amortization of bonds, but IFRS requires the effective interest rate method. And so there's a pretty important difference here between ASPE and IFRS. ASPE does allow the choice to use the effective interest method, but IFRS requires it. So the straight line method is not allowed under IFRS. We're going to start with the straight line method and we'll move quite quickly to the effective interest rate method. So example, here's another example. A company issues 10-year bonds with a par value of $800,000 on January 1st, 2020. Interest is payable at 10% annually on December 31st. The bonds are issued at 97. Prepare the journal entries using the ASPE straight line method. So if the bonds are issued at 97, are they being issued at a premium or at a discount? Definitely at a discount because 97 is less than 100. So to figure out what cash we're going to receive, we know we're going to receive less than 800,000. So we're going to take the 800,000 and multiply it by the 97% where they were sold at 97. So that's going to give us $776,000. So our entry is going on issuance of the bond is going to be debit cash, 776,000, credit bonds payable, 776,000. So the difference between the 800,000 and the 776,000, or rather the $24,000 difference, is recognized as interest expense. And a portion will be added to the interest payment each year to determine the total interest expense. So basically what that means is that when the bonds go onto our statement of financial position, they're at 776,000. But what we know is that in all scenarios, ASPE or IFRS, when the bonds mature, so looking back at this question, so they are going to mature in 10 years. So in 10 years on our statement of financial position, the bonds have to be at their face value. So ASPE has one method of bringing, in this scenario, because they're at a discount, bringing the bond value up to 800,000, and IFRS has a different method to bring the bond value up. But regardless of which method you're using, at the maturity of the bond. They have to be in our statement of financial position at the 800,000. So the straight line method permitted by ASPE basically just straight lines the difference. So basically it says, okay, well, we have got a $24,000 difference. 800,000 minus 776,000 is 24,000. We've got 10 years. So it's just going to take 24,000 divided by 10, straight line. And we're just going to recognize that much each year. So each year we're going to recognize $2,400. So you can see there on December 31st, our first amortization entry, debit interest expense, credit bond payable. You can see the credit's going to bond payable here, which is increasing the face value of the bond. So we're already getting closer up to the 800,000 every year. And in 10 years, we'll be up to the 800,000. All right, bonds issued at a premium. So we've looked at par, we've looked at a discount, but now we're going to have a premium where our bond's actually better than the market rate. So when bonds sell above face value, borrowers are matching the market rate, which would be lower. The selling price is the same as with discounts. It's the present value of the principal and interest over the term of the bond. So whatever the present value of those cash flows is what we're going to receive from investors. So let's look at an example. So a company issues 10-year bonds with a par value of $800,000 on January 1st, 2020. The interest is 10% payable annually on December 31st. Bonds are issued at 103. So what's 103? That means they're issued above face because it's 103%. So what does that look like? So we know we're issuing them at a premium. So first we recognize the sale with a premium. So we don't have to calculate, the reason we don't have to calculate the present value in this question, like we did in one of the other ones, is when it tells us what they're issued at. So in the previous question, it said they were issued at, I think, 96, 97. And here it's telling us the bonds are issued at 103. So that gives us the present value of the cash flows. If it didn't say that and it gave you a market interest rate, then we could calculate the present value. But when it gives us either 103 or 97 or what have you, then we're able to calculate what we receive for the bond as the present value. So here you can see we're taking 800,000 times 1.03. So that's going to be 824,000. And our journal entry is debit cash, credit bonds payable. So now we've got a premium. So we at maturity, we still need the bonds on our statement of financial position at $800,000. Now we've got them on our statement of financial position at $824,000. So rather than in our previous scenario, we're trying to bring it up. Now we need to bring it down each year to make sure that when the bonds mature, they're still on our statement of financial position at $800,000. So we are going to amortize the premium. We're going to bring it down. So we're going to, same thing, is still ASPE straight line method. So the difference here is $24,000 is the premium. 800,000 minus 824,000 is 24,000. So 24,000 divided by 10, because it's a 10-year bond, is going to give us $2,400 a year to amortize. If we do that 10 times, then we'll bring it down to 800,000. And our journal entry here, it goes the other way. So now we're debiting the bond payable because we're bringing down the 824. So it's going the opposite way as the liability in our balance sheet. It's debiting it, decreasing the liability, and crediting the interest expense. Okay, so one last complication is that in all the previous questions we looked at, we bought the bond, whether it was at a premium or at a discount or at par, we bought it on one of the interest dates. So let's say the interest is paid, January and June, we bought it either January or June. But what happens if you buy the bond in the middle of the interest date? Maybe you don't want to buy a bond in January or June. Maybe you want to buy a bond in February or March. What happens then? So if you buy a bond between interest dates, buyers will pay the seller the interest that has accrued from the last interest date to the issue date. So payment in advance for the portion of the payment they will receive on the next payment date but will not have earned. So what that means is, let's say that you receive, I don't know, $10,000 in interest every 6 months. If you buy the bond right in the middle of that interest payment, then you need to compensate the person that you're buying it from for the 3 months of interest that they earned, but they haven't received because the cash only comes out every 6 months. And then when you get the 6 months of interest, then you'll be reimbursed for the 3 months that you gave the person that they had actually earned for those 3 months. And then you'll get the 3 months of interest from when you actually held the bonds. You'll receive your 3 months of interest. So we make sure that we're compensating. Bonds operate perfectly. So whatever that person earned, they need to receive it. We basically front it to them, and then we get the payment when it comes out. We're reimbursed at that point. So here's an example. A company issues 10-year bonds with a par value of $800,000 on January 1st, 2020. Interest is at 10% payable semi-annually on January and July. The bonds are issued on March 1st at 102. So March 1st is not January or July. So it's not an interest date. And we're told that they're issued at 102. So let's see what that looks like. Okay. So the bond payable is going to be the present value, which we know is at 102. So we're going to have 800,000 times 102 is going to give us 816,000. So the bond payable liability on our balance sheet is going to be at 806,000. And we know that that's at a premium because it's at 102. So it's higher than face value. So it makes sense. It's at 816. Now the cash that we're going to receive is not going to be 816. It's going to need to account for the fact that this interest payment wasn't on an interest date. So we bought it when it wasn't on an interest date. So, or we sold it when it was on an interest date. So basically what we do is we say, okay, well, the interest expense is 800,000 times 10% of the note times 2 out of 12, because the person, these were issued on, I think, March 1st. So we've got January and February that we owe the previous holder of this bond. That means we owe them $13,333. We owe them that, so we're recognizing interest expense on day one, which isn't common of our bond entries. And then the cash is going to be the bond payable that we received, or that we owe back at maturity, plus the interest expense that we need to recognize that we're compensating the previous holder for, which is going to be the sum of those, which is going to be $829,333. Now, when we actually receive the interest payment on July 1st, we're going to receive cash for 800,000 times 10% times 6 over 12. We're going to receive $40,000. So we're going to recognize $40,000 of cash, and then we're going to be able to reduce. Let's see. Then we're going to be able to reduce our. Then we'll be able to only recognize the difference in our interest expense. So the investor will net 26,667. So 40,000 was received on July 1st, less the 13,000 that we paid upfront, which is the equivalent of 4 months of interest. So basically, you only receive interest for the period in which you're holding the bond. Otherwise, you're paying back in advance the interest to whoever you're purchasing it from for the period that they held that bond. All right, so we've gone through the straight line method, and now we're going to move into the effective interest method. So let's talk about the effective interest method with a discount. So this is a very common method. Some companies use it under ASPE too. ASPE is nice because it's simple, but the effective interest method is required for IFRS. So let's look at an example of how we would do a bond issued with a discount using the effective interest method. So $100,000 of 8% bonds were issued on July 1st, 2020 that are due in 5 years. Interest is due on January 1st and July 1st. To achieve an effective interest of 10%, the bonds are sold for $92,278. So let's just pause here for a second. So the face value of these bonds is $100,000. And the amount on the bond itself is 8%. The market rate is 10%. So do you think this bond would be at a discount or a premium? So we've got 8% and the market rate is 10%. So they're going to need to get 10% out of these bonds that we're doing that only have 8%. So definitely at a discount, which makes sense. The question says they were issued for $92,278. So we're going to record that as our entry. So debit cash, credit bond payable. This is obviously the same between ASPE and IFRS. The difference is in amortizing the premium and the discount. So how we amortize the premium and the discount with the effective interest method is a little bit more complicated, but I suggest that you memorize the format of this table, and we'll go through it quite a bit in the tutorials. And you will always have all the information that you need for any sort of an exam question or quiz question. So let's take a look at what this table is. So this is a schedule of a bond discount amortization. You can see along the left, we've got a column for the date, and the date is going to outline any date that the first one's going to document the date that the bond was issued. And then afterwards, it's going to show any interest payment dates. So this particular bond pays interest on January 1st and July 1st. So you can see it's always January 1st and July 1st each year. The cash paid. So the cash that's paid on the bond is always exactly the face value of the bond times the bond rate, and then adjusted for if it's semi-annual or not. So you can see in this example, the interest paid is $100,000 times 8% times half a year. So this is always the bond rate, because any difference between the market rate and the bond rate has already been taken into account of the present value of the bond. Then the next column is the interest expense. And this is where we're going to take the carrying value of the bond from the last column of this table, and we're going to multiply it by the market rate. So you can see here, it's taking the carrying value of the bond, the first one, which is 92,278 times the market rate of 10%, and then adjusting it for the semi-annual nature of the bond payments, half a year. And that's going to give us, in that first line, July 1st, 2020, is going to give us an interest expense of $4,614. So you can see that there's a difference between the cash paid of $4,000 and the interest expense of $4,614. And the difference is $614. And that difference is what we're amortizing in terms of the discount. And so we really need to be thoughtful here about if we're increasing the value of the bond or decreasing the value of the bond. So here we are going to increase the value of the bond. We need it to be on our statement of financial position at $100,000 at maturity. So you can see the 614 adding to the initial carrying value of 92,278. So our carrying value at July 1st, 2020 is 92,892, increasing. And then we continue going through that cycle. The cash paid is always the same because that matches up with the stated information on the bond, but the interest expense changes. The market rate stays the same, but because we're multiplying it by the carrying value of the bond, each time that you're recognizing it, you're multiplying it by a different carrying value. So you can see that at July 1st, 2020, the carrying value of the bond has increased. It went from 92,278 to 92,892. So therefore, when we multiply it by 10.5%, it changes. It went up now, the amortization that changed, the discount amortization or the interest expense, in July 1st, 2021 isn't the same as it was for July 1st. Now it's $4,645. And that's the reason that interest expense column changes, is because you're multiplying it by the carrying value. So to record the first interest payment, we're going to simply take the information right off this table. So we're going to have debit, cash paid, interest expense, and amortization. So we're going to have debit interest expense, credit bonds payable. So this is actually increasing the value of the bond because it's a liability. So now we're bringing that bond closer up to the face value. And then we're going to credit cash because we're actually going to be paying out the interest payment. The effective interest rate with a premium is very similar to a discount. The only difference is that now, instead of increasing the value of the bond on our statement of financial position, we're actually amortizing a premium. So we need to make sure that we're reducing it. So the value of our bond needs to be going down. The amortization of the premium will actually reduce the expense each month. So we're going to be crediting our interest expense. And the carrying amount of the bond will decrease by the amount of the amortization. So like we said, that value of the bond is actually decreasing. So we're debiting our bond payable. So the entry is the opposite way as it was with the discount. Under the effective interest method, amortization of the premium or discount results in constant interest rates. Straight line produces a constant amount of interest. So the straight line is simply saying, well, it's going to be $2,400 every month, whereas this is using the market rate of interest is the same, but that changes because the carrying value is changing. So the numbers, the actual entries themselves are not at the same amounts. And we'll look at some questions during the tutorial of the effective interest rate method used for bonds that are issued at a premium. So let's also talk about what happens when we issue a bond between interest dates. So it's exactly the same idea. It's just now we're going to prorate the amounts in our table. So the interest and amortization will be prorated by the number of months. So assuming the year end was February 2020, our interest expense January to June would be $4,000 and our discount would be $6,000 or $614. So we're basically just prorating it. So if we owed $4,000 for January to June, and we were going to recognize a discount of $614, then we would say, okay, well, January to June, it's the end of February, so we need to pay the person back for January and February. So that means we're going to say $4,000 times 2 out of 6 months, January and February, out of the 6 months interest payments that we are going to receive for that first payment. So we're going to pay them the $1,333, and also we're going to need to recognize the amortization proration. So that's going to be 614 times 2 over 6, which is going to give us $204.67. So our total expense to accrue would be $1,538. It's exactly like what we talked about with the ASPE straight line method. We need to reimburse any prior holders for their portion of the interest when we buy the bond. And so that's what we're doing here. Just another nuance that we want to talk about is notes issued for cash. So non-market rates of interest. So if there's a 0 interest-bearing marketable security issued for cash, fair value is the cash received by the issuer. The implicit interest rate is the rate that causes the fair value to be equal to the cash that's received. And any difference between the face amount and this present value is the discount or amortization that's amortized over the life of the note. If it's a non-marketable instrument, so then we're going to assume that if cash consideration is not equal to fair value because there's something else in the mix, then we are going to need to think about that differently. For instance, let's look at an example. To help finance the construction of a building, the government provides $100,000 in cash in exchange for a $100,000 5-year 0 interest-bearing note at face value when the market rate is 10%. So the government's basically saying, listen, we'll give you $100,000. We need to know we're going to get it back. So we want a formal note payable, but we're not going to charge you interest on it, even though we could go somewhere else and earn 10%. So the government's forgiving the interest that the company would normally be charged. So what this means is that in substance, the company is getting a loan and a government grant. So they need to account for that forgiven interest differently. So they're going to have debit cash. They're getting $100,000 in cash. They're going to need to calculate the present value of the note. So using a calculator and all the information we just talked about, the note payable present value is going to be $62,092. And the difference between that and the cash that they received is going to be recorded as a capitalization to buildings, and they'll be amortized through depreciation. Notes can be issued for property, goods, or services. So if the issued debt is a marketable security, the value of the transaction would be equal to the fair value of the marketable security. And if it's not, then we basically do our best to estimate the fair value of the property, goods, or services. One thing that we did say is that most notes or bonds payable are accounted for at amortized cost. And this is most common in both IFRS and ASPE. However, it is possible under IFRS to use the fair value option. And so this means that long-term debt could be recorded at fair value if it results in more relevant information. So this would require any changes in the value of the note to go through unrealized gain or loss in OCI. So let's look at an example. A company has $100,000 in bonds outstanding. At the end of the year, the company's credit risk has increased and the fair value of the debt is now $95,000. The company has chosen the fair value option for this debt. Well, the debt actually decreased in value. It was worth $100,000. Now they're saying that their risk increased and now it's only worth $95,000. So if the company was recording it at fair value under either IFRS or ASPE, then the differences in the value, that the decrease in the value of the debt, the $5,000 change, would be recorded as a debit to bond payable because you're decreasing the value of the debt on your balance sheet, and you're going to put the difference into unrealized gain or loss OCI. When the debt matures, then you would need to clear out OCI. And that's the end of chapter 14, part 1. Please join me for the tutorial section of this lecture where we'll go through a variety of questions. And afterwards, we'll continue with chapter 14, part 2.